Are the markets right now in a good position, given what we know is going to come from the Fed and given what we expect from the CPI report later on today?
I don't think markets are in a good position for the next couple of quarters. Whether they could rally on a decent CPI report or not is to be seen. I think that there's an immense short base in the equity market, in fixed income markets, and currency markets. We, again, have seen rallies like we did from June through August. We could see rallies again. But the monetary policy tightening, the tightening that is still to come, and the economic consequences, which take time and have not been given a moment to really catch up to the reality of this policy, will still unfold and still impact markets into the early part of the coming year until there is some real pivot.
So Stephen, we spoke with former Atlanta Fed President Dennis Lockhart just earlier in the show, and he expects the Fed to maybe be able to take a pause in the first half of next year to assess what's happened. This has no doubt been one of the most aggressive interest rate hiking campaigns, if you will, since going back to the Volcker days. What kind of damage really can be done to this economy? It could be pretty severe, could it not?
Well, look, I would view the outlook as likely having about 2 million job losses for the U.S., the unemployment rate rising above 5% over the course of next year, even if the Federal Reserve were to limit additional rate hikes from here. Think about what's happened. Mortgage purchase application volumes are off 50%. Home sales have already fallen 35%. Housing job losses have been zero. The pace of construction right now is really where we were when the sales pace was higher and mortgage rates were lower. Now, that's one micro example, just to understand that it takes time. It's planning a house, building a house is 12 months. This is one that we easily understand. The fact that there are very strong impacts on trade, which is impacting, again, marketing, sales, finance positions, throughout the economy, this takes time. In the past, it has, and it's going to right now. It might happen a little bit faster. And when I said, by the way, that, when the Fed pivots, when ultimately they react to job losses, that doesn't mean that the economy has stopped falling, and then some reaction to that is still there for many sensitive asset prices. Many, again, industrial and materials, these types of companies and these types of sectors, again, just the fact that the Fed will not tighten further at some point is not going to mean that they won't react to that further deterioration in the economy for a time.
So if that's the case, Stephen, the way that investors or traders, I mean, there's a distinction between the two, for sure, based upon tactical and strategic moves with money. How exactly, then, are you advising clients to position, given that economic outlook that could be the better part of next year in that negative zone?
Well, look, markets have never bottomed when we haven't even begun a recession. If a recession is coming, again, if it's a false warning, we would love that. But when we actually have a recession, markets don't bottom before the recession even begins. But all this market timing, all of these things sort of ignores the long-term value of staying invested in the most innovative parts of the economy that ultimately drive long-term economic growth. For the meantime, though, you can swerve portfolios to durable sources of income. We love the fact that we can put money to work in 1 to 3 year U.S. fixed income markets and now get yields ranging from 4 to 7% across a wide range of different risk categories, all investment grade. We have put a massive amount into U.S. bonds, about a 12 percentage point of portfolios, while still only having a very small global overweight in fixed income, avoiding Europe, avoiding Japan, these sorts of things. And international markets where the dollar has soared, we've stayed underweight these international equities, swerving to pharmaceuticals, to staples, to companies that have the most durable dividends. This is just a defensive tilt in portfolios, but this is not to say that markets already haven't anticipated a significant downturn. I think that the larger part of the market correction is in fact over.
All right, we've just got a few moments left, Stephen. What do we think about technology? It's led out of the previous, I don't know how many recessions. What happens to that tech trade?
I just be careful that, again, the earnings hits to some technology areas will come too. And that will also impact those companies. But the idea that the only problem markets have is higher rates, right, which has impacted growth stocks more, I think it will be economic weakness. And it will probably be those less economically sensitive technology companies that will bottom earlier. And that will, I think, likely come next year.